All right, let's get right into it. The Bank of England just made a huge call, deciding to keep interest rates locked in at 4%. So today, we're going to break down exactly what this means for your savings, your mortgage, and, well, pretty much everything. So, is this good news or bad news? Well, it's not that simple. This decision has pretty much split the country into two camps, creating some clear winners and some clear losers all across the UK. Let's dig into who gets what. Okay, so first things first. What actually happened? Well, on November 6th, 2025, the Bank of England hit the pause button. 4%. That's the magic number. The UK's base interest rate is staying put, which is basically the country's top economists signaling that they're playing it safe for now. You've got to understand, this is a super delicate balancing act. The bank is trying to navigate this really tricky path between high inflation on one side and a sluggish economy on the other. So this pause, it's a huge relief if you're a saver, but it definitely keeps the pressure on if you have a loan. All right, now for the part that probably matters most to you. How does this decision actually hit your wallet? Because yeah, this is where it gets personal. And really, it all boils down to this huge divide. If you're a saver, 4% is a good thing. Your cash is still earning a decent return. But if you're a borrower, it's a real squeeze, because the cost of your mortgage and any loans you have is staying stubbornly high. And this quote, man, it just brings it all home, doesn't it? Think about Sarah, a teacher. Her mortgage payments are now £300 higher every single month. That money has to come from somewhere, right? And for her family, that somewhere is their holiday fund. But then you've got the other side of the coin. For someone like Tom, a retiree, this steady rate means an extra £2,000 a year is trickling in from his savings. And for him, that's just enough to really treat his grandkids, which is fantastic. Okay, let's look at the hard numbers, because this is where it gets really stark. The fixed rate deals are, relatively stable, but just look at that standard variable rate, the SVR. That's the pricey rate you get dumped onto when your fixed deal ends. At 7.5%, it's over £400 more a month than a 2-year fix. That's a huge, huge burden for the 1.5 million people stuck on those rates. So you might be wondering, why on earth did they make this call? What were they thinking? Let's get inside the bank's mindset for a minute. It really all boils down to one word, inflation. Remember when it peaked at a painful 11.1%? Well, now it's down to 3.8. I mean, that's great progress, right? But the bank's magic number, their official target, is 2%, and we are just not there yet. And get this was a total nail-biter. The committee that makes the decision voted 5-4 to hold rates. The fact that it was so close, with 4 members actually pushing for a rate cut, is a huge signal that a change might be coming sooner rather than later. Governor Andrew Bailey had this perfect analogy for it. He said, it's like dieting. The hard work is done, the weight is off, but you're not about to read the fridge and undo all that progress. So, that fridge door leading to cheaper borrowing, yeah, it's staying firmly shut, at least for now. And this really gets to the heart of what the Bank of England is always trying to do. It's this constant, nerve-wracking tightrope walk between keeping prices under control and making sure the economy doesn't grind to a halt. It's a tough, tough job. But here's the flip side of that coin. The economy is really struggling. Growth is flatlined and unemployment is starting to creep up. This is exactly why those 4 members voted for a cut. They were worried that keeping rates this high could actually tip the economy into a recession. Okay, so that's the why. Now what about what's coming down the pike? Let's look at what the crystal ball says for the next few months. Well, if you look at what the financial markets are saying, they're already placing their bets. Right now, they're pricing in about a 60% chance of a rate cut in December. But, and this is a big but, it is absolutely not a done deal. So, if you want to be in the know, there are 3 key things you've got to watch. First, the autumn budget. Any big tax or spending changes could change the game. Second, what are the big central banks in the US and Europe doing? And finally, of course, that all-important inflation report on December 18th. These are the big ones that'll signal which way the wind is blowing. Okay, so with all this going on, what can you actually do right now to protect your finances? Here are 4 smart moves. First, attack any high-interest debt you have, like credit cards. Second, consider locking in a good fixed-rate savings account while the rates are still pretty high. Third, if your mortgage deal is ending soon, don't wait. Start shopping around for a new one early. And finally, build up that rainy day fund. It's your financial safety net. And that really brings us full circle, back to that big question. Was holding rates steady a smart, pragmatic pause to make absolutely sure that inflation is beaten? Or was it a massive missed opportunity to give the struggling UK economy the shot in the arm it so desperately needs? And I think, as we've seen today, the answer to that question really depends on which side of that savings and borrowing line you happen to be standing on.